Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'm Kevin Hincks. I've got two paper money trades for you today, two high-profile names. First, we have Apple, that received a very bullish downgrade today, price target change. I'll talk about that in a moment. And then we'll look at American Express that has earnings coming out after or tomorrow morning before the open. So we'll look at both those today, and let's get right to it. First, Apple. Now, as you know, Apple, right around Christmas time, hit a high of about $260, just over that, and has fallen fairly precipitously. I look at the 3-month chart, down 3.7%. The 1-month chart, down 10.8% in the last month. So it's basically gone from a high of just over $260 to a low yesterday. I believe it was around $219. Now, why is that significant? If you look at a chart, and a 200-day moving average of Apple, it's about 217.84 on the Thinkorswim platform. So it got right pretty close to the 200-day moving average, which it was quite a ways from at one time. Now, the downgrade today. Let's talk about, they kept them, Goldman Sachs kept a buy rating on Apple, but lowered their price target to $280, still $20 above the all-time high. So it's the most bullish price target decrease in history, as Apple, the new 280 price target is still $20 above the all-time high. So Apple was starting to touch the oversold area. You can see the stock is up, 1.2% today. So that's a little bit of recovery. They have earnings coming out January 30th after the bell. So the paper money trade we looked at here in Apple is this. We went out to the February 21st expiration and bought the 225 call, basically the at-the-money call in the February 21st expiration. And then we went into, not this week, but next week, which is the earnings event, right? If you look at the implied volatility, we sold then the 235 call, so a $10 call diagonal, buying the February 21st, selling next week's earnings event implied volatility. Why is that? Well, number one, look at the implied volatility of next week, a 44, the February 21st, about a 32. So we're trading the dispersion in the implied volatility there, buying the low, selling the higher number. So we're selling it. Now, you could do this later. You could wait till the implied volatility gets to its peak in that earnings event, but this is a time where if that front goes up, it's very possible that the February 21st expiration may go up as well. So the debit on that, I put it in about $5.25. It's rallied since then. It's now $5.75. So the risk on this trade is the debit paid. Always remember, on these risk-defined strategies that we talk about here, the risk is the debit paid. It peaks out where? The 435 strike next week. So if the move for next week in Apple is about $12, that's inside the expected move for next week, is where this would max out. But if you look at the profit graph, it flattens out, doesn't it, at a profitable level. It's not like a textbook calendar spread where it comes up and then comes back down if it moves away from that strike. As long as it's bullish, as long as the move is bullish, it can go as high as it wants and you still remain profitable. Okay, there's our trade in Apple. Now let's get to our earnings event for tomorrow morning, and that is American Express. Now, if you look at the chart on American Express, an incredible run. They're similar to Visa and MasterCard, but different also, right? Visa and MasterCard are a conduit for spenders. They make money off swipe. The difference between American Express, they hold debt, right? They hold those values. They usually cater to a more affluent customer. They've got a strong brand. Everyone knows what American Express is. They've got higher returns because they charge interest on those balances. They hold the balances. Visa, MasterCard do not do that. They're usually affiliated with a bank. So it's just a different way that they do that. Now, that's the good news. The RSI touching 70, so a little overbought the stock. If you look at 12 months, up 74% in 12 months, up 33.9% in 6 months, so an incredible run. That's going to be reflected in our trade. The expected move for tonight's move is about $12.30. That's where the one-day market maker move is. So this is a little more complex trade that we did here. We're going to sell tomorrow's expiration. We're going to sell the 340 or 335, 340 call vertical, right? First, two trades. A complex trade consists of two fundamental trades. First one, short call vertical, selling the 335, 340 call vertical, using that credit to purchase the January 31st, January 24th, 310 put calendar. Why do these trades together? Here's why. Because it's reaching oversold, the bar is extremely high. So if it hits that downside market maker move of $310, that's where the calendar spread would make money. But this whole package, the short call vertical and the long put calendar, the whole package is trading right around uneven. So you do that for no money. It was trading about a 30-cent credit earlier in the day, but the stock has, I think, backed off slightly. No, it's up small on the day, up about 65 cents. So this is one that remember, because you're doing it for no debit or credit, or if it rallies a little more, if you do it for a credit, you are profitable or don't lose money if it stays right here, right? If it moves down, then you take advantage of that move on the short call vertical and the long put calendar. But because you do it for no debit, you have very little risk on the upside. Now, you do have risk. Make no mistake, you do have risk on this trade. The risk is a move higher than $335 towards $340. That's where the risk is on this trade. It's the risk. That's why you have a $500 margin on this, because the $5 call vertical on this spread. So a little more of a complex trade there, selling the call vertical to finance the long put calendar. So we've got a long call diagonal ahead of the earnings event in Apple, and looking forward to American Express's earnings. We've got the complex trade, short call vertical, long put calendar. That's our show for today. Have a great day, everyone. We'll see you tomorrow with another version of the Daily Trader. I'm Kevin Hincks.